There's a 2-year-old ute going up on the back of a tow truck on an ordinary suburban street, and the man watching it happen is the one who financed it. Nobody stole it. The tray's barely scratched, the tires still have most of their tread, the bull bar hasn't seen a single scrape of gravel. He's just standing on his own driveway, holding a coffee he isn't drinking, watching his work vehicle roll away on a flatbed. Now, before we go one step further, I need to correct the headline you clicked on, because that's the deal on this channel. You cannot return a ute in Australia. There's no cooling off counter at a dealership, no 3-day grace window, no receipt you hand back once you've signed and driven off the lot. That's not how vehicle finance works here, and it never has been. So when I say thousands of Australians are returning their new utes in 2026, what's actually happening is worse than a simple return. It's a ute being taken back by a lender, or handed over voluntarily because the owner can't keep up, while the debt attached to it keeps chasing them anyway, long after the ute itself is gone. By the end of this, you'll understand exactly why this is happening to utes specifically, even though utes are some of the best vehicles in the country at holding their value. You'll see the 3 ways this actually plays out, the real numbers driving it, why tradies specifically are more exposed to it than the average car buyer, a genuine blind spot hiding in one very common way utes get financed in this country, and exactly how to check whether your own loan is quietly heading in that direction before it becomes your driveway with the tow truck in it. Stick around for the whole thing, because the part that actually protects you is near the end, not the opening scene. The 2 lines. Here's the idea you need before anything else in this video makes sense, and it holds whether you're in Alice Springs or the outer suburbs of Adelaide. Every ute loan is a race between 2 lines. The first line is what the ute is actually worth on any given day, and it only ever moves in one direction, down. The second line is what you still owe the bank, and it comes down far more slowly than most buyers expect, especially in the early years of the loan. The gap between those 2 lines is what finance people call negative equity. Strip away the jargon and it just means you owe more than the ute would fetch if you sold it tomorrow. Here's why that gap opens up so fast. The moment a new ute leaves the dealership, it sheds value quickly, and in the first year that drop can be substantial before it slows into a more gradual curve. Meanwhile, your loan repayments in year 1 are mostly interest, not principal. You're paying the bank for the privilege of borrowing the money before you're actually paying down what you owe on the vehicle itself. So for a chunk of the early loan term, on almost any ute financed with a low deposit, the value line and the debt line are traveling at completely different speeds, and the debt line is winning. Think of it the way you'd think about a trailer with a poorly set up tow ball. On paper, the load looks balanced. In practice, weight is shifting in a direction you can't see from the driver's seat, and you only notice the sway once you're already at speed on the highway. A loan works the same way. The contract looks balanced on the day you sign it. The imbalance only becomes visible a year or 2 later, once the value's already dropped and the balance hasn't caught up. Why this is ironic for utes specifically. Here's the twist that makes this story different to what you'd expect. Utes are not bad vehicles for this. If anything, they're some of the strongest resale performers on the market. A well-spec'd Toyota Hilux can retain well over 60% of its purchase price after 5 years, which is a genuinely excellent outcome by industry standards, and utes generally hold their value better than most passenger cars and SUVs in this country. So this isn't a story about buyers choosing a vehicle that falls apart in value. It's a story about a genuinely strong-performing asset getting wrapped in a loan structure that can still outpace it, at least in the early years. That's an important distinction, because it means the fix isn't by a different ute. The fix is understanding the loan sitting underneath whichever ute you buy, because even the best-performing vehicle in the country can leave you underwater if the finance around it was stretched too thin, for too long, against income that looks steadier on paper than it turned out to be in practice. And this is exactly the point one industry insight team made when reviewing negative equity trends overseas, which holds just as true here. This is fundamentally a financing problem, not a vehicle choice problem. You can do everything right when picking the ute itself, choose the model with the best resale reputation in the segment, and still end up upside down, because the failure was never in the drivetrain. It was in the contract sitting on top of it. The numbers behind the trend. Let's put real figures against this, because a claim without numbers is just a feeling, and this channel doesn't run on feelings. Vehicle repossessions in Australia have been climbing steadily over the past couple of years. One of the country's largest vehicle auction houses has reported a double-digit rise in repossessed vehicles arriving at its yards over the past 6 months, with the pace picking up again in the most recent quarter alone. Automotive arrears data from the banking sector tells the same story from a different angle. The share of car loans running more than 90 days past due is now roughly double what it was 2 years ago. That's not a blip in one dataset. That's two independent sources describing the same upward trend from different directions. It's serious enough that Australia's corporate regulator opened a formal review into the car finance sector in 2026, examining aggressive sales tactics, excessive fees, and interest charges, and whether lenders are properly checking that borrowers can actually afford what they're signing up for in the first place. Two figures out of that review should stop you in your tracks. Nearly half of all borrowers who default on a car loan do it within the first 6 months of taking it out. Not year 3. Not year 5. 6 months. And among vehicles that get repossessed and then resold, close to 9 out of 10 borrowers still owe more than half of the original loan balance, even after the vehicle itself is gone. Sit with that for a second. The ute is taken. The debt isn't. Part of what regulators are specifically looking at is whether some lenders are approving loans based on a quick glance at income rather than a genuine assessment of whether repayments are sustainable once every other bill is accounted for. That review hadn't concluded at the time of this video, but the fact that it exists tells you this isn't a minor statistical wobble. It's significant enough that a federal regulator decided it needed a formal look. Why tradies specifically carry more of this risk? Now here's where this stops being a general car market story and starts being specifically about your driveway. Utes make up a meaningful share of all vehicle finance taken out in this country, well ahead of vans, motorcycles, and heavy trucks combined as a proportion of loan purpose. That's not surprising once you think about who's actually buying them. A ute usually isn't a lifestyle purchase for a tradie. It's the tool that earns the income in the first place, which changes the risk profile in a way that rarely gets discussed openly. A huge number of tradies operate as sole traders, paid by invoice, job to job, rather than a fixed fortnightly salary. Income can look completely healthy averaged over a year and still swing hard from 1 month to the next depending on which client pays on time and which one sits on an invoice for 6 weeks. Lenders don't always price that variability accurately at the point of sale, and a tradie under pressure to get a new ute on the road for a job starting Monday doesn't always shop the loan with the same care they'd shop the vehicle itself. Add to that the fact that running costs around ute ownership have climbed at the same time as the loan repayment. Insurance premiums have been rising sharply across the board. Servicing costs keep climbing. Diesel prices have had sharp spikes this year. None of these show up on the finance contract, but all of them draw from the same monthly budget the loan repayment is coming out of. A tradie also tends to put harder kilometres on a ute than the average commuter, between towing, worksite conditions, and unsealed roads, which means repair and tyre costs tend to land more often and more expensively than the finance calculator ever accounted for when the loan was first approved. None of that makes a tradie a worse borrower. It makes the income and expense picture genuinely more volatile than the neat monthly figure on a loan contract suggests, and that volatility is exactly what gets exposed the moment something goes wrong. Door 1. The underwater trade-in. When a ute owner hits the wall financially, there are really 3 doors out, and every single one of them gets loosely referred to as giving the ute back by somebody, even though none of them work anything like a simple return. Door 1 is the underwater trade-in. This is the quietest of the 3, and probably the most common. You bring the ute back to a dealer wanting out, maybe because the repayments have become unmanageable, maybe because you just want something smaller. The dealer does the classic move, rolls whatever you still owe into the loan on your next vehicle. Say you owe $52,000 on a ute that's genuinely worth $44,000. The dealer gives you $44,000 on the trade, folds the $8,000 shortfall into the new contract, and you drive out in your next ute already thousands of dollars behind before it's lost a single dollar of its own value. The only lever left to make that new repayment livable is the same lever that caused the original problem, stretching the loan term even further, which slows the principal down even more, which makes the next negative equity gap even more likely. It's worth saying plainly, this isn't illegal, and it isn't even unusual. It's a completely standard part of how trade-ins get structured when the numbers don't line up cleanly. The problem isn't that the option exists. The problem is that most buyers don't realize they're choosing it, because it's presented as solving the immediate headache of getting into a new ute today, not as a decision that reshapes the next 5 to 7 years of their finances. Door 2. The voluntary surrender. Door 2 is the voluntary surrender, and this is the one growing fastest right now, if the trend data from the banking sector and the auction houses is anything to go by. You call the lender directly and hand the keys over before a tow truck shows up uninvited. It feels like the responsible move, and in a way it is, compared to simply going quiet. But understand exactly what happens next, because this is where people get caught out. The lender doesn't forgive the debt because you were upfront about it. The ute goes to a wholesale auction, where it typically sells for meaningfully less than it would fetch listed on a dealer's website, because the buyer at that auction needs margin to recondition it and sell it on again. The lender then deducts towing, storage, and auction fees before applying whatever's left to your loan balance. Whatever remains outstanding is called a deficiency balance, and it is still legally your debt. It can be pursued through the courts, it can attach to your wages, and it can follow you for years after the ute itself is long gone. On top of that, a voluntary surrender still lands on your credit file, generally treated in much the same way as a repossession would be, which can knock a serious chunk off your credit score and sit on your file for years afterwards, making your next loan, your next lease, even some rental applications, harder to get approved. If you're ever in this position yourself, it's worth knowing that lenders in Australia do have hardship provisions you can formally request, things like a temporary repayment pause or a restructured term, and asking for that conversation early, before you've missed several payments in a row, generally puts you in a stronger position than going quiet and letting it drift toward door 3 instead. Door 3. The involuntary repo. Door 3 is the one nobody actually chooses, the involuntary repossession. You stop answering the calls, the letters stop getting opened, and one morning the ute simply isn't in the driveway anymore. If you're picturing someone with a clipboard staking out your street the old-fashioned way, understand that's not really how recovery works anymore. Camera-equipped vehicles now sweep car parks, shopping centres, and suburban streets scanning number plates automatically against national finance databases as they drive past, no stakeout required. Plenty of newer utes, particularly ones with factory-connected apps for remote locking or servicing reminders, can report their own location back through the same systems that run their satellite navigation. The ute you're hoping stays hidden at a job site or behind a mate's shed may be quietly telling the lender exactly where it's parked. Once repossessed, it goes through the same wholesale auction process as a voluntary surrender, with the same deficiency balance risk and the same credit file consequence, except now it's compounded by whatever additional legal costs the lender incurred chasing you down in the first place. And because the ute itself is registered as security against the loan on the National Register, there's no version of quietly selling it privately to get ahead of the situation either. Any buyer doing a basic check before purchase will see the loan attached to it, which means the debt effectively travels with the vehicle until the lender is paid out, one way or another. The Novated lease blind spot. There's a fourth wrinkle that's specific to how a lot of Australians finance vehicles that doesn't really exist in the same form overseas, and it's worth understanding if your ute is set up this way. A meaningful share of vehicle finance in this country runs through a Novated lease, where your employer makes the lease payments directly out of your pre-tax salary. It's genuinely a good deal for a lot of PAYG employees. But here's the catch that rarely gets explained clearly at the point of signing. The arrangement depends entirely on your employer agreeing to keep facilitating it. If you change jobs, get made redundant, or move from employment into contracting, which happens constantly in the trades, the Novated lease doesn't just quietly transfer with you. Unless your new employer specifically agrees to take it over, you become personally responsible for continuing the payments yourself, using after-tax income, exactly like a standard loan, except now without the tax advantage that made the deal attractive in the first place. For a tradie whose whole career is built around moving between jobs, between employers, and in and out of subcontracting arrangements, that's a piece of financial fine print that can turn a smart tax structure into a personal liability overnight. It's not a reason to avoid Novated leasing altogether. For plenty of PAYG tradies in stable employment, it remains a genuinely efficient way to finance a ute. It's simply a condition worth reading in full before signing, rather than discovering it for the first time in a call to HR the week after a redundancy notice. What this looks like with real numbers. Let's run this against an actual, current ute, because vague numbers don't help anyone make a real decision. Take a well-optioned dual cab, the kind of mid-range Ford Ranger or Toyota Hilux sitting in the $40,000 to $60,000 bracket that most tradies actually drive away in, rather than the flagship variant closer to $90,000. Financed with a modest deposit at current secured car loan rates sitting around the mid-7% mark, stretched toward the longer end of what's typically available here, that ute has already shed a meaningful chunk of its value within the first 12 months, the way any new vehicle does, while the bulk of those first year's repayments have gone toward interest rather than actually reducing what's owed. Now compare that to the same ute bought with a genuine 20% deposit and a loan term kept closer to 4 years instead of stretched toward 7. The value line still drops at the same pace either way. But the debt line falls far faster in the second scenario, which means the crossover point where you're no longer underwater arrives years earlier. Same ute. Same depreciation. Completely different exposure to a bad 6 months. Now stack the running costs on top of either scenario, because the loan repayment is never the only number leaving the account each month. Comprehensive insurance on a newer dual cab, registration, a service interval every 6 to 12 months, and fuel for a vehicle towing a trailer or hauling a loaded tray most days, all draw from the same pool of money as the loan repayment. None of that shows up on the finance contract, and none of it gets easier just because the repayment itself is fixed. When 2 or 3 of them land in the same month, a repayment that looked comfortable on day one can suddenly feel like the tightest bill in the household. That's the whole story compressed into one comparison. It was never really about which ute you chose. It's about which loan you signed underneath it, and how much room you left yourself around it for everything else that comes with actually owning and running the thing. Who actually profits from this? None of this is an accident, and it isn't a mystery either, once you follow where the money actually goes. A dealership rarely makes its real profit on the price of the ute itself. The margin on the metal is thin, and increasingly public, given how easy utes are to price compare online now. The real profit sits inside the finance office, the interest rate markup over what the lender actually charges the dealer for the money, the add-ons stapled onto the contract at the last signature, things like extended warranties, paint protection, and gap insurance that cover the shortfall between what you owe and what the vehicle is worth if it's written off, and above all, the cycle itself. There's very little ongoing money in a tradie who buys a sensible ute, pays it down steadily, and drives it for the next decade. That customer is a dead end for the finance side of the business model. There's a great deal of money in a buyer who finances more ute than they strictly need, comes back underwater a couple of years later, and rolls the shortfall into the next contract. That customer never really leaves the cycle. The lender earns years of extra interest. The dealer earns a fresh contract with the old debt quietly tucked inside it. Nobody in that finance office is doing anything illegal. It's quiet, ordinary commercial arithmetic, built around a customer trained to ask what the weekly repayment is, instead of what the total cost of the loan actually comes to over its full term. None of the individual people in that finance office are villains in this story either. They're working inside a structure that rewards the contract that generates the most interest and the most add-ons, the same way a salesperson anywhere gets rewarded for the deal that makes the most margin, not necessarily the one that leaves the customer in the strongest position 5 years later. The real stakes for a tradie. Here's what makes this sharper for a tradie than it is for the average car buyer. When someone loses a family hatchback to repossession, that's a genuine hardship, and nobody's minimizing that. But when a tradie loses their ute, they can lose the ability to earn an income at the exact same moment. No tray means no tools on site. No tow rating means no trailer, no gear, no job that day, and potentially no job the rest of that week either, if the client's already lined up someone else. It's rarely just a vehicle problem in isolation. It becomes an income problem, arriving at precisely the moment the person can least afford one. And it gets sharper again outside the major cities. In a lot of regional and outback areas, there's no backup public transport network to lean on while you sort out a replacement vehicle, and the next town over might be an hour or two away. Younger buyers are also showing up disproportionately in the delinquency data coming out of the banking sector right now, often because they're leaning on family support to get into their first ute in the first place, with a smaller financial buffer if a slow month hits early in the loan. For an apprentice or a tradie a few years into their own business, that first ute is frequently also the first serious piece of finance they've ever taken out, signed under real pressure to get earning as fast as possible, with none of the hard-won instincts a more experienced buyer picks up after their second or third vehicle loan. How to check if your own loan is at risk. Before we get to what to actually do about all this, run a quick, honest check on your own situation, because most people in this position don't see it coming until it's already close. First, do you actually know what your ute would sell for privately today, versus what you still owe on the loan? If you've never checked, that's worth doing this week, not eventually. Second, if your income dropped by 30% for 2 consecutive months, starting tomorrow, could you still make the repayment without touching savings you don't have? If the honest answer is no, that's the gap this entire video has been describing. Third, do you actually know the total interest cost of your loan over its full term, in dollars, not just the weekly or monthly figure on the contract? If you can't answer that number off the top of your head, it's worth pulling out the paperwork and adding it up properly, because that number is designed to be the one you never look at too closely. Fourth, if you're shopping for a used ute right now specifically to sidestep some of this risk, run a check on the National Personal Property Securities Register before you hand over a deposit. It takes a few minutes, it costs a small fee, and it tells you immediately whether there's still finance owing against that exact vehicle. A ute with money owing on it can still legally be repossessed from a new owner who bought it in good faith, if the previous owner's loan was never properly paid out, so this single check protects you from inheriting someone else's version of this exact problem. What to actually do about it? So here's what actually matters, whether you're buying next month or already sitting in a loan that's tighter than it should be. First, if you're underwater right now, the boring move is usually correct. Keep the ute, keep paying, and let the depreciation curve flatten while your principal repayments do more of the work as the loan matures. The gap closes on its own if you stay in the boat. Second, never roll negative equity into a new loan. If you genuinely need to change vehicles, step sideways into something cheaper, not upward into something bigger. Third, if you're buying new, put down a real deposit, keep the term as short as you can genuinely sustain, and be honest about how variable your income actually is before signing for the flagship trim instead of the mid-spec model doing exactly the same job on the tools and the tray. Fourth, negotiate the ute's price and the loan's total cost as two separate conversations, and get your own finance pre-approved before you walk onto the lot. Fifth, if you're on a Novated lease, understand exactly what happens to it the moment you change employer, before you're relying on it. Sixth, if you can feel one of these three doors approaching, call your lender before they call you. Hardship provisions exist for exactly this, and lenders work with people who reach out early far more readily than with people who've gone silent for months. Do all of that, and in a few years the ute sitting in your driveway is actually yours outright. The paperwork's filed away in a drawer, and when it eventually needs a repair at high kilometers, you can afford to fix it properly, because it's a bargain on a ute you already own, rather than one more cost stacked on top of a ute you never really did. Tell me in the comments, what did you actually pay for your current ute, and how long did you finance it over? Half the ideas for this channel come straight out of what tradies tell me down there, so don't hold back. And if you want to know exactly which utes are genuinely worth financing in 2026 versus which ones are quietly setting up this exact trap, that's coming in the next video.